The Berkshire Hathaway annual meeting is always one of the absolute highlights of the investment calendar, and this year in 2023 the meeting really didn't disappoint. Although it is technically a formal meeting of Berkshire Hathaway shareholders, it's really more of a very long-form Q&A session with two of the greatest investors to ever play the game. That, of course, being Warren Buffett, this year 92 years old at the meeting, alongside his partner Charlie Munger, who is 99 years old. Both of them were absolutely full of wisdom at this year's meeting, and I think they recognized maybe the lack of pace that they showed last year in 2022's annual meeting. They had the goal of getting through about 60 questions over the session, so for two 90-year-olds to sit up there and answer questions for like 5 hours straight and be able to recall numbers off the top of their head and explain quite complex concepts in very simple terms, it's always super impressive, and it was really the same again this year. As has been the case for a couple of years now, in the morning session of the Berkshire meeting, we also had two of Buffett and Munger's deputies up there answering questions, that being Greg Abel, very likely the future CEO of Berkshire Hathaway after Warren Buffett is no longer able to be the Berkshire CEO, and Ajit Jain, who runs all of the insurance operations at Berkshire. Now, there was an enormous amount covered during the meeting. The CNBC full video of the meeting is here on YouTube. I think it's like 7 hours long, including all the breaks and everything. So an enormous amount covered. I won't be able to get through all of it in this video, but in this video, I want to cover some of my personal key takeaways from the meeting around Berkshire, the business's underlying performance, and then also some of the key topics that were sort of recurring themes throughout the meeting. Buffett and Munger's thoughts on banking, on their big oil investments, on the bet they've made on Activision Blizzard stock, recent performance of their insurance businesses, and much more. So if you enjoy the video and haven't subscribed to the Investing with Tom channel already, please be sure to do so, and let me know down in the comments below some of your highlights from this year's annual meeting. But with all that said, let's get straight into the video. Now, the first takeaway is really to do with Berkshire Hathaway itself and Berkshire Hathaway's recent business results. Going into the weekend, Berkshire Hathaway reported their earnings for the quarter ending in March 2023, and as has become the case in the past few annual meetings, Buffett provided some additional commentary on top of the recent results, and also shared a few numbers around some of the things Berkshire have been doing in their stock portfolio subsequent to the end of the quarter at the end of March. Berkshire reported operating earnings for the first quarter of $8.065 billion versus $7.16 billion in the same quarter last year, and Buffett himself said most of our businesses will report lower earnings this year, but he did note that investment income was up. That's largely to do with a lot of Berkshire's shorter term investments, their sort of cash and cash equivalents. They've really benefited significantly in terms of their operating income from the rise in interest rates recently. For a long time, Berkshire had their sort of idle cash just sitting around earning basically nothing. Since interest rates have recently gone up quite substantially, that cash is now actually sitting there and earning a return. So Buffett said that their short-term cash equivalents, basically money invested in short-term government bonds, was previously earning them about $50 million a year. That has grown to $5 billion per year with very little change in the actual amount of money invested. It's really just a big jump up in interest rates that's helped them in that department. And at a higher level, Buffett shared that operating earnings over the years have grown a lot and they will continue to grow in future. And that's largely a result of Berkshire for a very, very long time essentially retaining all of its earnings. Berkshire famously doesn't pay a dividend. Instead, the cash from the operating businesses and dividends from the stock portfolio gets sent to Omaha, gets sent to Warren Buffett to reallocate, to buy more businesses and buy more stocks and continue to grow the operating earnings at Berkshire. Buffett actually shared that Berkshire did pay a dividend all the way back in 1967. They paid a dividend of 10 cents a share. Now that's 10 cents per A share, which now trades for like hundreds of thousands of dollars. And he said that, quote, it was a terrible mistake to pay that dividend. If he had instead retained it within Berkshire and compounded it at the same rate he's compounded all the rest of the capital that stayed at Berkshire, that 10 cents a share would be extremely valuable today. He shared that float in the insurance businesses has grown to 165 billion. He basically described float as money that's not ours, but that we can have working for us. He said it's a pretty valuable asset that shows up on our balance sheet as a liability, and it's somewhat akin to a bank deposit, but it is importantly different. It can't disappear overnight, and it's cost them almost nothing. And this has been one of the major advantages at Berkshire Hathaway over time. They have these large insurance businesses where customers typically pay up front for an insurance policy. Berkshire then generates this cash that's not really theirs, but they're holding on to, that they call float. It's essentially cost-free, assuming that their insurance businesses are generating reasonable underwriting profits, or are at least about break even on an underwriting basis. They can then take that float, invest it, and benefit from the income and capital gains that can come from that investment activity. Cash was about $127 billion at the end of March. Buffett also shared that in April they've probably added about $7 billion to that number, which would take them into the mid sort of 130s. He said in April they bought about $400 million in stocks. They sold about $4 billion in stocks, so it will be quite interesting to see over the next couple of 13F filings what stocks were actually sold down by Berkshire there. And he said they'll probably have operating earnings in the month of April of about $2 billion. And finally, in terms of sort of operating results at Berkshire, they do seem to have sort of restarted some of their share buyback program. By my maths, shares outstanding was down about 0.65% just in the first quarter of 2023. So that's an indication that Buffett clearly thinks Berkshire Hathaway shares are at least somewhat trading below intrinsic value. He said many, many times that buybacks can either be the best thing or the worst thing you could do, and that's very dependent on the relationship between the price of your stock relative to its intrinsic value. So if you can buy back stock below its intrinsic value, that can be very, very good for long-term shareholders. So interesting to see a little bit of that happen in the first quarter this year as well. Now, the second major takeaway from the Berkshire meeting for me was around, their recent purchase of Alleghany. That was a big acquisition that Berkshire did last year. It's a mini Berkshire in some ways, where it has some insurance operations and then also has investments and wholly owned businesses as well. And additionally to that, Ajit Jain also shared some interesting recent growth in Berkshire's reinsurance business around basically insuring super catastrophes, hurricanes, earthquakes, and the like. So on those couple of insurance topics, Ajit basically shared that Alleghany will continue to operate as a separate unit. There is going to be no change in terms of how they run their insurance operations. There won't be any sort of integration to capture potential synergies or anything with the insurance units. Alleghany will quite simply just keep doing what it's always been doing. But in terms of their sort of catastrophe insurance activity recently, Ajit said they had a lot of dry powder kind of ready in December for a big renewal date. Now, he said they didn't do as much business as they'd hoped to. Capital kind of came out of the woodwork and pricing and reinsurance deteriorated. He did say, however, that they still had a lot of dry powder ready for April for a big renewal date in terms of kind of pricing renewals in this insurance segment. And he said the pricing environment got a lot better, margins are healthier, and they've written a lot of business. They've written a lot of insurance policies recently. Ajit said their exposure today is up 50% from only 5 or 6 months ago, but they have a very unbalanced portfolio. In particular, he said they could lose as much as $15 billion across all their policies if there were to be hurricanes that causes damage and these kind of insurance policies kicked in. And he said they have a very unbalanced portfolio. They're particularly exposed to Florida, and their exposure in terms of the way they think about it is about a 5% bet, I guess, in terms of Berkshire's total insurance capital. Buffett clearly likes Berkshire writing this type of business at current prices. He sort of told the story that Ajit gave Buffett a call just to kind of double check that Buffett was okay with an extra couple $2 billion of exposure in their catastrophe insurance business. Buffett said that the call lasted less than 30 seconds and that he really hopes he gets another one of those calls and they can keep writing more business at these prices. And this whole discussion really hits on a few pretty unusual things that Berkshire are able to do, just given the way that their business is structured and the fact that they're not purely an insurance company. They have other operating businesses and they have a big stock portfolio, which means they're really overcapitalized in their insurance businesses, particularly relative to other competitors in the industry. And that means that if prices are good and insurers are getting paid good money to write policies on the risks that they're taking, Berkshire will write a lot of insurance volume and they'll do a lot of business, as Ajit puts it. But if prices are poor, they're not really in a position to where they'll just keep writing business to kind of keep up appearances, even though it'll be bad for margins. They are more than willing to kind of step back from the insurance market, write a whole lot less business, and just keep powder dry, as Ajit puts it, until prices improve. And because of their size and scale, they're also able to have these really unbalanced portfolios. They're particularly exposed to Florida right now, and that's because pricing and margins on those insurance policies is really good in Florida, so they write more business in that area. They're not sort of forcing themselves to have some arbitrary diversification just for diversification purposes. They're looking at the pricing of particular insurance policies, and if they think the pricing is attractive, they'll just write more business. Moving on now, one of the major topics that came up again and again and again throughout this meeting was some of the recent turmoil that's been happening in the banking sector, and also how Buffett and Munger are currently thinking about banks as investments. And it's kind of funny if you've been following along with the whole Silicon Valley Bank implosion. You might understand the joke that Warren Buffett made here, where he busted out these signs that said available for sale and how to maturity. Accounting jokes aren't always that funny, but I thought that was pretty good one. In terms of what Buffett had to say about all these recent bank failures, he said that basically the environment is similar to what it's always been. Fear is contagious, sometimes fear is justified and sometimes it isn't. And he said that setting up the FDIC deposit insurance and so on was enormously smart. If people can't trust that their money is safe in a bank, we can't run an economy very well. And he also shared that although there's a $250,000 deposit limit that many people will know about, the US government have no interest in deposits being lost. One thing I did find quite interesting about Buffett's comments on recent bank runs and sort of the stickiness of deposits around banks was if people think deposits are sticky anymore, they're living in a different era. And basically what he was getting at was, back in the day, if you were concerned about the health of a bank and you wanted to get your money out of said bank, you would have to go down to the bank branch, stand in line. The person behind the counter at the bank would be trying to give money out as slowly as they possibly can so that the bank doesn't completely fail. But that's really quite different today. Everyone will have banking apps on their phone. They can remove money from a given bank very, very fast, and you can have basically bank runs in an instant. Speaking further on bank failures, and specifically on First Republic, which he actually named in the meeting, he said in the 10K in First Republic's annual report, you could see they were offering mortgages in jumbo amounts at fixed rates, sometimes for 10 years before they would change to floating rates. He said that's just a crazy proposition. If interest rates go up, essentially, the bank earns a very low yield on their assets because they've written these very long-term mortgages. And if rates go down, people can come in and try and refinance. And the bank's kind of on the poor side of the deal in both of those different circumstances when they write these very long-term mortgages. Further on First Republic, he said it was in plain sight. People basically ignored it until the whole thing blew up. The stock was being sold by insiders. He says, who knows if that was innocent or not. But basically, directors and the CEO should suffer. Basically, currently that doesn't happen. It's not a good lesson for people with the future of the economy in their hands to see directors and CEOs take unnecessary risk and cause, bank blow-ups and things. They should basically be held accountable. He said shareholders and bondholders should lose money, but depositors should not. There were also some quite interesting insights around some of the older bank investments that Buffett and Munger made. He said back in 1969, they actually bought a bank at Berkshire, and in that year, they had $19 million invested in banking versus $17 million invested in insurance. He said if you follow sound banking methods, which means not doing some things that other people do, a bank can be a perfectly decent investment. He said the Bank Holding Company Act came in 1970. And if that hadn't been passed, Berkshire might have owned a lot more banks instead of insurance companies. He said they were looking for other banks, but they had to divest from their bank holding within 10 years. At this point, Charlie Munger actually jumped into the conversation and had some pretty compelling comments on the whole thing. He said, and by the way, this is talking about the bank that they owned in 1969. He said, and by the way, it never had a bad debt, it never had an unnecessary cost, it made nothing but money with no risk, it never presented any deposit insurance risk to the government, and any person who deserved credit could get credit. So they were clearly quite annoyed back in, the late 1960s or 1970 when the Bank Holding Company Act was passed. Buffett went on to say again that you could run a perfectly sound bank then and you could still run it today and you could earn very good money. He said the banking industry was bigger and there were basically more targets to buy. So it's quite interesting to take away from Berkshire and Buffett and Munger. If that Bank Holding Company Act of 1970 hadn't been passed, Berkshire could look very, very different than it does today, where today they're very heavily tilted towards insurance. Perhaps they would have been far more heavily tilted towards banking if that regulation hadn't gone through, over 50 years ago at this point. And finally, on banking, on sort of the topic of what they've done with their stock holdings, which is largely sell out of all the banks except Bank of America, and the question of, big banks versus regional banks and so on, he said, we don't know where the shareholders of the big banks or the regional banks are heading. Buffett explained that his own personal money is with a local bank and it's above the $250,000 limit. And he said communication has been poor. Politicians and others are involved that don't really understand banking, and the American public is probably as confused about banking as ever, and that has consequences. But nobody knows what the consequences will be. You don't know what the stickiness of deposits will be at all, and that changes everything. Now, one of the big things that we've seen in the last year or so out of Berkshire Hathaway is some quite significant bets on two major oil companies, that being Chevron and Occidental Petroleum. We learned of sort of the size and scale of that bet at last year's Berkshire Hathaway annual meeting, and they've sort of continued to buy these stocks over the last year, particularly Occidental Petroleum. So it was really no surprise to this year get a couple of questions on Berkshire's oil investments and how they think about the companies. Buffett explained that it's actually Charlie Munger that probably knows more about the sort of physics behind oil and has been investing in the oil industry the longest. Munger actually shared that just before he met Warren Buffett way back in the day, he paid $1,000 for an oil royalty that still to this day in 2023 is now paying him about $70,000 a year. Buffett then jumped in and said that that sort of very long-lived oil production from a single site is the exact opposite of the Permian Basin. And the Permian Basin, for those unaware, is where a significant portion of Occidental Petroleum's assets are. Explained that in the Permian Basin, on the first day of a well, you could produce, say, 12 to 15,000 barrels in a single day, but in a year or a year and a half, it could be practically nothing. US production today is about 11 million barrels of oil per day. And if shale production stopped, that could drop to 6 million barrels very fast. Imagine if it stopped. Plus, we're depleting the strategic petroleum reserve. And his point around saying all of that was basically when you buy into an oil company, there are lots of different types of oil businesses. There's some of these very long-lived wells, and there's some sites, like particularly in the Permian Basin, where they have relatively short lives. He reinforced, as he has done in years gone by, that the results of investing in an oil company are very dependent on, of course, the price of oil. He said if oil sells at X, you do very well. If it sells at half of X, it doesn't work as well, but it will bring down production very fast. We don't know what oil prices will be, but we do like the position Occidental has. He explained that some of their position in Occidental preferred stock has been reduced because the company at their option has retired it at about 110% of its par value. So he said they had about $10 billion of this Occidental preferred stock, about $400 or $500 million of which has recently been retired. And they sort of wrapped up the Occidental and oil conversation with a bit of praise for the CEO, Vicky Holub, who, interestingly, her first job was at a company called City Services. City Services preferred stock was the very first stock that Warren Buffett ever bought. So that's an interesting little piece of history there. And he also sort of dismissed any rumours that Berkshire Hathaway might be about to sort of make a bid to buy all of Occidental Petroleum's assets. He said that they kind of wouldn't know what to do with it. Charlie would like to do that, maybe much more than Warren. And they're happy to just be owners of the stock, at least at this point in time. My final highlight from this year's Berkshire meeting was a bit of commentary on Berkshire's merger arbitrage or merger workout bet on Activision Blizzard. Now again, this is one that Warren Buffett shared in last year's annual meeting. He basically said he had invested a significant sum of money into Activision Blizzard stock with the hope that the shares would then be acquired by Microsoft. Microsoft had made an offer to buy Activision, and there was quite a spread between the market price of Activision Blizzard and the buyout price offered by Microsoft. He said last year that one thing they did know for certain is that Microsoft had the money, but there were of course going to be a lot of regulatory hurdles about the deal getting approved by various international regulators. He did say that they try and avoid giving too much info about the stocks that they're buying or selling at any particular time, and you should instead just look at the 13F. That's what they disclose because they have to. He did say you can sort of infer some things from their quarterly filings, the 10Qs and things, but you'd have to look pretty hard for it. So it sort of seems like he was suggesting that he might maybe be out of Activision Blizzard in terms of this merger workout situation now, but he didn't say it explicitly, and we'll have to wait for the 13F data for that to be confirmed, if at all. He did say that he thinks Microsoft have been remarkably willing to cooperate with government bodies. They seem to have met more than halfway, but the UK, at least at this point in time, seems to be trying to block the deal, trying to block the purchase of Activision by Microsoft. So those are some of my highlights from this year's 2023 Berkshire Hathaway annual meeting. It was another great session. I thought that especially for 90-year-olds, but even much younger people, Buffett and Munger were very sharp this year. They picked up the pace a bit in 2023 after being quite slow to get through questions in 2022. And although I've shared a lot of my highlights in this video, it really does just scratch the surface with the wide range of topics that were covered in this year's meeting. So if you haven't watched already, I would definitely recommend checking it out. I'll leave the link to CNBC's stream in the description below. But I do hope you enjoyed some of these highlights. If you did, please give me a like on the video and subscribe to the channel if you haven't already. But that's it from me for this one, and I'll see you in the next video. Cheers.